Okay, and we are live. Let me double check. I believe we are live. Let's have a look. See. Okay, can you hear me, Tyler?
Loud and clear.
Loud and clear. Okay, guys, welcome. GWB, the Generational Wealth Builders Community. Sorry, it's been a long time coming. There's been a lot going on, but today I have the pleasure of hosting Tyler Okland once again. He's not a stranger to the channel. Our live stream, bro. Our last live stream actually blew up. It's the most viewed live stream that I've done on my channel, Tyler. Did you know that?
I didn't know that. That's great though.
It got a lot of support, a lot of comments. I think a lot of people loved your commentary on SOFI, and SOFI has been crushing it as well. I mean, earnings yesterday. There's a few people that you won over on SOFI in the Discord, and they loved it.
It's nice to be right about one stock.
And hopefully, Opendoor. Well, I mean, yeah, we'll get into it. But the reason why I invited you on, Tyler, is because I wanted us to go through Opendoor's Q4 earnings, and also the full year results, what your expectations were they met, and also going into into the next year, 2022, what you're modeling going forward, and just generally your general take, because I do want to plug this article right here. It's called The Art of Winning. Oh, an Unfair Game, right? So this is Tyler's most recent article. You guys need to take an afternoon. If you're an Open Door shareholder, take an afternoon, go through this. It's very detailed, very lengthy, but when I mean it's the best article I've read regarding Open Door, that's an understatement. So it will be linked in the description below for more details. But Tyler will give us a summary. Okay, is that all right, Tyler?
Yeah, that's great. You want the summary now?
Not quite yet. Not quite yet. So let's take a look at earnings. What did you think of earnings?
Yeah, I mean, I think let's see. Revenue came in line with what I forecasted. Gross profit as well.
Yeah.
I think highlighted 14x year-over-year growth. Overall on the year, they posted 9.1% gross margins, which were ahead of expectations. Contribution margins came in at 6.5%. That's also above the guide for expectations. And adjusted EBITDA ended the year positive. So overall, that was kind of the good thing, the good financial headlines. And then, there were things like doubled market footprint, expanded buy box, acquired 3 companies, including 2 digital renovation and 1 digital mortgage company, launched 2 new products. I mean, overall, scaling from basically zero inventory, I think 2021 was a defining year.
Yeah.
The market did not like the quarter for a couple reasons, and it sold off sharply.
Yep.
I think the headline net loss was higher than anticipated, and people really focused on the overall stock-based compensation component of net loss in 2021.
Yep.
Which, I mean, we can dive into that a little bit as well. I don't mind the stock-based compensation, considering 2021 was the year Opendoor went public. Given the amount of revenue that it has, I think as a percentage of revenue and gross profits, it's continuing to decrease. So that's a positive. But overall, the headline net loss was greater than anticipated. And this is not a market where you can have anything short of perfection and live to fight another day.
Yeah. I mean, okay. So Tyler, do you have me up elsewhere? Because people are saying there's a bit of an echo in the background. No. Right. Okay. Let me know if that's clear, guys, in the chat. But apparently I'm echoing.
Huh.
Can you hear echo on your side, Tyler?
No.
I can't hear it echo either. Let me know in the chat, guys. Am I echoing or not? Okay. There's a slight echo. Okay. 1 second. Okay, they're saying it's much better now. Okay.
Okay.
Okay, guys, can you hear me? Is that better? Is that okay? It's all better now. All good. Okay, good. Right. So, you hit on a few things, Tyler, and let's take a moment to look at the stock. Okay. So, before earnings, you can see we had a huge run up, right? We ran up from 860 all the way to pretty much about $11, right? And that was off the back of OfferPad. So OfferPad reported earnings the day before, and they pretty much proved that the iBuying business model can be profitable. So that's why we saw a huge spike. And then of course Opendoor came out. Like you said, the net losses were higher than expected. SBC higher than expected. Contribution margins as well also saw a decrease, even though it was within range. It decreased. What do you think was the main cause for the huge sell-off that we saw the very next day?
For Opendoor?
Yeah, for Opendoor.
Yeah, I mean, I think it was the headline net loss number. I think it was higher than anticipated, like I said, and I think there was expectation, given the scale that Opendoor achieved in revenue, that it would be closer to break even than it was. Yeah, I think there were a few issues that weighed on Q4's profitability. So one was increased holding times, just as a consequence of seasonal aspects of Q4, and then there were things like selling costs were higher because Opendoor probably used more external real estate agents to manage demand, and then there were also extended home repair timelines. A couple reasons potentially for that, but you have to remember Q4 includes 3 major holidays. There's a lot of downtime, a lot of vacation time. Like, I don't know, probably at least 3 weeks of 3 months is generally considered vacation time in the United States. So I can imagine that there will be some delays in managing renovations and refurbishing.
Yeah. So with the holding periods, right, we increased to about 120 days, and that incurred further costs. Okay. Is that a concern of yours going into Q1 and Q2? The holding periods, because initially it was 90 days, then 100, and now it's 120.
Yeah. I think overall they're guiding for turnarounds of about 120 days, at least for the foreseeable future, which means 3 turns of invested capital per year. I think long term, that's something that they'll look to optimize in the future. But while they're continuing to lean into their growth curve, it seems like 3 turns in a year is pretty good, especially in light of how many more homes they're starting to sell.
Okay. So they're saying the echo's back, Tyler, and people are saying it's coming from your end. Can you see the chats? Tyler, mute yourself when you don't speak. Apparently, the echo's coming from your side.
I can't see the chat, but I'm not sure what to do.
Yeah. Okay. So I've got echo. Okay. People saying okay, the echo's back. Yeah. Right. Okay. I'm not entirely sure what to do either. Is it really bad, guys? You want us to continue with the echo, or what we can do, Tyler? Maybe is try and sort it out the back end and then reattempt. I'm thinking we do that. Okay.
Yeah, I don't see any chat.
Okay. So yeah, they're saying when I'm speaking, they can hear the echo from your end. That's what people are saying in the chat. So, okay. So what we're gonna do, guys, we're going to end the stream now, and we're going to try and sort it if we can. If not, we'll probably record something live. Well, not live stream it, but just do a normal recording and then post it as a post as opposed to a live stream.
Emmanuel, it sounds like I just need to mute when you're talking. We can try that. Here, I'm going to mute while you talk, and let's see if that works.
Okay. Okay, guys. So Tyler's muted. Can you hear me now? Is there an echo? Let me know. Let me know, guys, in the chat. Has the echo gone, or can you guys still hear the echo? Okay, so no echo. Right. Okay, so I think I think that's we've reached a resolve. Thanks for your help there, Mikhail, in the chat. Right. Okay. So Tyler, essentially, how this is going to work then? When you can hear me, Tyler. So when I pause or ask a question, then you can unmute yourself and then talk, and we will work with that. So yeah, Tyler, let's talk about SBC. Okay, stock-based compensation. Now, there's been a lot of talk about this online. Came in ridiculously higher than people expected. People are really taken back by the SBC amount. But when you look at it, when you look at the financials, a lot of it was at the initial stages for when they went public via SPAC. That's the huge amount of SBC. And if you look at the trend, it's been trending lower. But what's your take? And can you see why the bears are using this as a reason for why Opendoor should go to zero?
Yeah. So it kind of surprises me that people were taken aback by the value of the stock-based compensation. They guided for 75 million in stock-based compensation in Q4 and ultimately posted 71 million. So they paid out less stock-based compensation than they guided for. So that's one. Two, 2021 was the year that they went public. And so, for a company that's been private 7 years with a salary cap, with a very, very operationally frugal culture, finally giving early shareholders in management an opportunity to gain liquidity, I think is very fair. And then, the other 2 points I'd make is one, Opendoor posted nearly 4 billion in revenue in the fourth quarter, and stock-based compensation was 71 million. Look at SOFI, which I'm a huge fan of. They posted 280 million revenue, and they're guiding for 85 million in stock-based compensation in Q1. Stock is up 15% after hours. So people choose what they want to fit their narrative, but stock-based compensation, in my opinion, is totally manageable for Opendoor, continuing to become a fraction of overall revenue trending down. And as Opendoor achieves the scale that I know it's going to, I think it's going to be manageable and then some.
Nice. And do you see them increasing it for full year 2022 going forward?
No. The high water mark is 2021 because it went public in 2021. I think it'll probably be in the range of 250 to 300 million in 2022. But remember, they have thousands of employees, and they're trying to attract missionaries. This is what I got. This is one of the points that I tried to get to in my article is they don't want mercenaries. They want missionaries. They're not going to be able to compete with Google, with Meta for these ridiculous, salaries. They have to be able to incentivize people who love the problem space, who are really passionate about that problem space. And to do so, they have to be incentivized for the company to do well. And that's stock-based compensation.
Right. Now, in terms of contribution margin, okay, we've had discussions in our Discord pretty much throughout the whole of the weekend. They guided between 4 to 6% CM, and they came in on the lower end of that guidance, and they haven't necessarily guided higher in Q1 as well. So why are we not able to hit higher contribution margins, because the argument is HPA is at the highest it's been. I've seen a lot of arguments there saying home price appreciation, we should be killing it, right? Again, people are doing comparisons between OfferPad and Opendoor. They have higher margins. Why is there a problem with Opendoor's pricing? Is that it? Like, where would you pinpoint the issue?
Yeah, there's a lot to unpack in that question. I think we can start with the Opendoor versus OfferPad comparisons. So it's important to remember that Opendoor and OfferPad serve two distinct but sort of subtly distinct markets. I've said this previously. Opendoor is a technology company that got into real estate. OfferPad is a real estate company that got into technology. But Opendoor is straddling the difference between those two. OfferPad is quite clearly in the real estate exclusively category. The amount of spend that they have on technology R&D is a fraction of what it is for Opendoor. And so especially at these early stages, I think it's going to be very clear that Opendoor is going to have inferior margins for many of the quarters, simply because they're investing in the future opportunity. When you look at who they're hiring at Opendoor, it's a tech company. They're hiring full stack engineers, Rails, backend, app designers, things like that. Whereas OfferPad is hiring handymen and realtors. You know what I mean? They're using realtors basically for the valuation that Opendoor is working to optimize. And the future opportunity means scaling into 100 billion plus revenue annually, buying and selling homes. And you can't scale people like that. You need technology at a certain point to scale people. And so early stage, it looks impressive, but the long-term opportunity, you're going to need that technology infrastructure and that investment to scale appropriately. And Opendoor, for example, talked about how they were able to make 110 basis points operational savings just by their investments in Scout, which is their basically homes project infrastructure app that they built from scratch over the past year, which is really impressive when you consider that we're talking about $4 billion in quarterly revenues. The other thing I'd say is that OfferPad is growing much more slowly, right? And so they're able to pick and choose homes much more cautiously. They have much stricter underwriting criteria, which means they serve and satisfy much fewer requests than Opendoor does. Opendoor wants to be, the single stop for every American home buyer and home seller. OfferPad is looking to define a specific niche of that market, which is much smaller, but you might see 100 basis points of gross margin superiority versus a company like Opendoor, which is fine. But long term, they're going to struggle with the technology infrastructure needed to scale.
And in terms of contribution margins, then us coming in on the lower end of expectations.
Yeah. So, I mean, contribution margins were still well within the guidepost that Kerry Wheeler has said for the near term for Opendoor, which is 4 to 6%. It just looks like a very precipitous decline when you consider, the first half of 2021, Q4 2020, et cetera. But I think, like I said, there were seasonal impacts there. There were also resale issues, right? So, the fantastic margins that we saw in Q1 and Q2 were a consequence of sort of the underlying economics of buying and selling homes at scale. So if you, for example, in Q1 2021, Opendoor bought many, many, many homes, right? They just began to scale up very rapidly. And the first homes that they're beginning to sell are the best homes of that bunch, right? That's just the dynamics of buying and selling. So you buy 3,000 homes. The first homes that you sell are going to be have the lowest holding costs, the lowest selling costs. They're going to be the highest margin because they're the easiest homes to sell.
Yeah.
But then as you start moving throughout the year, those lemons, or the homes that weren't as good, are going to start, forming a decent base of the homes that you're selling, and those margins are going to be lower.
Yeah.
Opendoor talked about the fact, or the management talked about the fact, that that's beginning to normalize, and now they just have a healthy mix overall. In my early Q1 checks show that profits are definitely going to come in at higher margins than Q4. That's for sure. I'm not going to give any like firm estimates at this point, because we still have about a month left of the quarter for all those pending sales to go through. But Q1 is definitely a superior quarter profitability wise than Q4.
Yeah, I would agree. And in the earnings call themselves as well, I believe it was Eric or Kerry said going into Q1, they have a strong inventory balance, and they're able to meet the elevated demand for the housing. So that puts them in a very strong position going into Q1. Okay, so I completely agree with what you're saying in terms of the contribution margins as well, and selling the lemons towards the end of the year. I like that. But yeah, no, I agree. Okay, so I'm going through some of the bear arguments I've seen online, because I don't want it to be just like, we're coming on to give ourselves or each other confirmation bias. I do want to tackle some questions and some concerns that I've seen. Okay, so someone mentioned, right, are we at danger of expanding too quickly? Okay, because of course we are now looking for engineers in Canada. We got so much plans in terms of how we're going to expand into more markets this year. Is there a danger that we're expanding too quickly and that's going to result as our downfall?
Yeah, I mean, I think a couple things. When you look at Q4 2021's performance versus the year ago quarter and how much Opendoor scaled in the interim, things are breaking probably constantly at Opendoor. Processes, technology. I mean, I bet things are constantly on fire at Opendoor because of how rapidly they're scaling. But at the same time, I think that they're the right company for that type of aggressive growth. They're sort of a startup at heart, even though they're 7 years in and they have massive run rate revenue ahead of them, as well as the opportunity. I think that's what it's going to be like at Opendoor, just like it was at companies like Google or Twitter when they went from 100 employees to 3,000 employees or whatever it was. Like, you're constantly having to reinvest in those teams and the infrastructure and the organization to make sure that you scale efficiently. And it's okay if things break. It's not the end of the world. As long as you have raw product market fit, you'll have time to fix things. And I think there's probably no other company on the planet that has the raw product market fit that Opendoor does, except for maybe Tesla a few years ago. It's just one of those things that people love, and it's a traditional process that's so broken that even in a seller's market of 2021, which I think was a headwind, I think it's continuing to be a headwind in 2022. Opendoor is shattering expectations, and that's because of their product market fit.
Nice. Okay, Tyler. So another again argument is we were sitting going into Q1. We're sitting on 17,009 homes in our inventory. So for me, that's a plus, okay, because the value that represented over 6 billion in value, okay. But the concern is, of course, we're going into an environment, high interest rates, mortgage rates are also going up. Is that a risk, having over 17,000 homes in our inventory? Because people, again, like you said at the start, people can twist it whatever way to fit their narrative. But what's your thoughts on that?
Yeah, so there's a lot of potential macro concerns. So let's start with like HPA, home price depreciation environment. In my article, I make the case that that's not that's not really a concern for Opendoor. In fact, I think they'd have an even greater value proposition if home prices were going down or we were in a depreciating environment, because that's a buyer's market, right? As opposed to a seller's market. Opendoor's flagship product is sell with Opendoor, right? So you've got your home, you sit on your couch, you get an offer for your home, you close, you've got equity in your bank account the next day, right? That's wow, a magic experience. That helps sellers. But the seller market, or the seller's market that we saw in 2021, homes are flying off the shelves, right? For $100,000 over asking price. The fact that Opendoor could still scale as rapidly as it did, despite that as a headwind, I think is pretty impressive. But it speaks to the fact that conversion and potentially even fees could be higher in a down market. And so Opendoor would still be able to hit those goalposts of 4 to 6% contribution margins. So that's home price appreciation. And then there's also interest rates and mortgage, right? So interest rates, again, very manageable. I've talked about this several times. Loop Ventures did a great piece on this. But let's say that interest rates go up 1% this year. Opendoor would only see 25 basis points of costs associated with that, which I think is super manageable. I don't think that's a big deal. And remember, as they're able to increase their speed of turnover of homes, so moving from 120 days to 90 days, that interest cost as a percentage of revenue is going to diminish. So yeah, I think that sort of covers the interest fees, right? It's a very small percentage cost that we would see as a drag on the business. And then mortgages, there's really no proof that rising mortgage rates have a direct relationship on home prices. But again, this all goes back to people saying like, oh, if mortgage rates rise, people are not going to want to buy houses, right? Or home prices are going to go down. That's not a headwind for Opendoor, because Opendoor thrives in all cycles, but it's particularly going to be a market maker in a buyer's market. And so mortgage rates go up, people don't want to, or people feel like their home is less valuable, or homes actually do become less valuable. That's not going to be a margin headwind for Opendoor's business.
No, well said. Well said. I completely agree. And again, it's people trying to twist things, and I think people are trying to guess and make assumptions for what they believe will happen. Again, it's just bearish arguments, and I'm trying to be open-minded to it, and that's the reason why I brought you on as well to discuss this. And also our Discord, we're seeing a lot of questions coming in because mainly because the stock is down, but these are valid questions for a company that's growing as quickly as Opendoor are and expanding as quickly entering into more markets. These are concerns, and I think they're valid concerns, but listening to the earnings calls, management has a plan, right? They have a plan. They have wiggle room as well. People forget that, especially with regards to the transaction fees, they have room there. Okay. And the margins, the spread, they have room. So I think people think like they're just starting this or doing this for the first time. But they've been doing this for years now. They're not a Zillow where they were doing something else and then just started this. This is their bread and butter. Okay. This is all they know. And they've thought about a lot of these things, and they have contingencies. And that's given me confidence. Okay. So let me see some more questions because I have it written down. And then I want to get into your article. Okay. Because your article I thought was excellent. All right.
One of the things I just want to double tap real quick on mortgages.
Yeah.
It's important to remember that we're still at decade lows for mortgage rates. It's still under 4%. I was talking to my wife's father the other day, and he said when he bought his home, the mortgage rate was like 18%. I say decade low, and the lowest point in terms of number of homes transacted was in 2008 at 4.1 million homes. Opendoor sold 21,000 homes in 2021, right? I think it's important to remember that Opendoor is scaling so rapidly, and mortgage small changes in mortgage rates that might influence mature players, that happens in saturated, mature markets, not nascent markets that are growing orders of magnitude every year. And so, yeah, there might be a small, like 3 to 4% headwind, but it's like a fly, hitting the windshield of a semi truck. Like, yeah, is there, if we're talking about physics, is there like an observable deceleration in the truck? Sure. But if you're standing on the side of the road, are you able to notice it? No.
Yeah. Agreed. Right, Tyler. Another point that came up from bears. Well, again, people just asking questions. Opendoor saw one of the highest sales to investors, institutions. Does this tarnish the company's mission to make it possible to buy and sell a home at the tap of a button, pretty much for the normal consumer, if Opendoor are selling a large amount of their inventory to institutions? Are they at risk of damaging people's ability to compete if they're competing with these institutions? Are Opendoor more favorable towards institutions? What are your thoughts on that?
Yeah, this is a complex issue. But I think at the heart of this is, it's easy to make this headline of like, oh, Opendoor is selling to corporations who, are making it hard for individuals to buy their home. One, the math doesn't support that, right? Opendoor sold 20,000 homes, of which 20% were sold to institutions. So 4,000 homes for a total of 6.5 million homes transacted in 2021 is a drop in the bucket. So I don't think that that's materially mathematically impacting an American's ability to own a home. The second point is, what do people think those corporations are doing with those homes? Because the true answer is they're renting them to consumers. And
Facts.
why is Blackstone, a worse person to rent from than an individual property owner? You know what I mean? Not to mention the fact that home rent prices are rising faster than home prices are. And as a consequence of how fast homes are appreciating in value, fewer Americans are able to buy homes. And so options are needed for Americans to be able to rent and have a place that they can live. So it's not like these homes are being purchased and then shipped off to another country or something like that. Like they're being purchased and then rented back to American consumers. So there's options both ways. I think again, this sort of falls into that gross misunderstanding of Opendoor's business model and the fact that real estate is emotional, it's personal, and especially residential real estate is. And so, it's easy, I think, to not look deeper into whatever the superficial headlines are. But at the end of the day, I don't see Opendoor selling to institutional investors as somehow fighting their mission to empower the American home buyer at all.
Because I saw the argument that they're in danger of creating a renters economy as opposed to the American dream of being a buyer. But like you said, I mean, what's the difference between Opendoor, or Blackstone, or was it Blackrock? Sorry, that you said. And I honestly believe it is a small part of total sales of who they're selling to. But do you believe at some point, maybe Opendoor will introduce like a cap in terms of, okay, this is our goal whereby we sell a set percentage of our inventory to institutions, and then the rest will be left for a normal buyer? Or you don't think that would be a good approach?
I just don't know why they would need to do that. The other thing I'd say is I think the percentage of homes that they sold to institutions was higher in 2021, specifically because of the HPA dynamics that we saw. Right, it's a function of supply and demand. So more institutional investors were looking to purchase homes from Opendoor because rent was skyrocketing, and so people needed more homes. That's one of the reasons why we saw the HPA dynamics that we did in 2021, because we just don't have the housing inventory that we need. And so home builders are just trying to produce as many homes as possible so that, we don't see such gross home price appreciation that we are seeing. But at the same time, there's two ends of that spectrum, right? Not everyone can buy a home. A lot of people are just looking to rent. And so, like, it's hard to say, oh, the home buyer deserves more options than the renter, right? Because some people need time to scale into their finances to get to the point that they can actually purchase a home. But both are giving, the American consumer the opportunity to live, in the home of their dreams. One is buying, one is renting.
Yeah, agreed. And I also want to touch on the point you mentioned about repair timelines, because in the earnings call, they made it clear that the repair timelines for new acquisitions are pretty much heading back to historical norms, because I've also seen people discuss that and use that as an argument. They're returning to historical norms, and it's just, I think if you listen to the earnings call with an open mind, a lot of these questions will be answered, and also in the annual reports. But okay, so Tyler, is there anything you wanted to say about overall Q4 and 2021? What were your thoughts? Because I've pretty much gone through all of the arguments I've seen. Personally, my conviction strengthened over Q4, and I took the advantage. I think it dropped below $8, and I give me more, give me more, because I'm very happy with what I'm seeing. Very impressed. I'm very impressed with the new additions that I've saw over 2021 going into 2022. What have you been buying? Has your bull thesis been strengthened, or has it been dampened? What are your thoughts?
Yeah, I think, like I said, it was a little bit of a complex quarter. I would have liked to see better margins overall, as I said previously, particularly on the contribution profit side. But that said, I think I was reminded of how early we are, and confirms what I have always believed about Opendoor, which is that it's a deeply misunderstood company. And that's what we're talking about today, right? We're talking about all these potential headwinds, and the superficial headline is often not as accurate, as long as you're willing to look a little bit deeper. But you really do have to look deeper with Opendoor to appreciate the opportunity. And if we're right about Opendoor, we're really early. And I think, when you look at the opportunity ahead, it's not going to be measured by quarterly performances necessarily. And we're going to have good quarters. We're going to have quarters where people are like, man, I would have liked to see a little bit better in this section or this section, or the macro headwinds are on their way and it's going to crush the company. But I truly believe, more than ever, that Opendoor is the best positioned company to capitalize on this opportunity, on this massive, massive growth curve ahead of itself. And I think Q4 and the full year results really, really just kind of etched that in stone. Like, this is the company that's going to change how we buy and sell homes. And it's going to do it with technology and fantastic customer experience and obsession. I think 2022 is going to be fireworks, bonkers growth as well.
Agreed. And also management execution, which they are executing phenomenally. Now, okay, guys, so if you're in the chat, write down any questions if you have any questions for us. Whilst you're doing that, guys, I want to give Tyler a quick moment to plug his Substack. Like I said at the start, this is insane. Okay, I love the way you write, Tyler, in terms of how you compare baseball, for example. You went through the history of how this. We don't have baseball in the UK, so I didn't know about this story at all. But it was interesting to learn about how data gave this coach, I believe it was, an edge, and that pretty much became the norm for everyone else. He had pretty much a basic team, from what I understood from reading, and it just shows again the power of utilizing data. It really does give you that edge. But do you mind giving us a summary like I said, it will be in the link in the description below, guys. Okay. But give us a quick summary. Like I said, it's not a 5-minute read. It's very detailed, but you know, you put a lot of time and effort into this. We really appreciate the content as well. But yeah, if you don't mind, Tyler.
Sure. Yeah. So Opendoor is my number one position, my highest conviction pick. And I've written a few articles about Opendoor before, but as this was their first year of earnings and operational performance, I wanted to kind of summarize my thoughts about the company, what made it different, you know, look to its performance, but also look ahead to what it could become in the future. So I sort of broke it down into a little bit of founding story, Q4 performance, early Q1 performance, particularly sales transaction acceleration, and then improvements in profitability metrics. And then we talked a little bit about Opendoor's common DNA from Amazon, and how Jeff Bezos was able to instill a culture of frugality, and Opendoor borrowed from that. And then kind of talked about what Opendoor looks like in the future. So looking at its profitability center, which I called Opendoor Home, which is the concept of internalizing both the home transaction services and you know, the home maintenance services into one seamless application. And then also touched on the risks like HPA dynamics, holding times, brand, things like that.
Yeah, I really liked the risk part as well, because you see a lot of analyst articles, they focus primarily on, oh, Tyler, do you mind muting? Yep. Yeah, on the risks. But yeah, and again, it opened up people to that possibility that, look, you know, we're still very early, okay? And being early carries a ton of risk. You know, there's going to be a lot of headwinds, going to be a lot of obstacles. You know, Jeff Bezos has said one of the reasons why Amazon succeeds is because they failed many times. So as part of the process, it's going to be very volatile. It's going to be very bumpy. But if you believe in the management, if you believe in the execution, if you believe in the business model, and if you believe in the problem that they are solving, then buckle up, buckle your seatbelts. All right, so I can't really see that many questions coming in. So Peter, Ty is not invested in HIMS. All right, so we're not going to put that up. But okay, so I guess they're asking, like, do you want to buy open now? Are you buying now? Are you a buyer, or are you holding at the moment, Tyler?
So I bought a little bit, but to be honest, right now I'm saving for a home myself, and so most of my finances are being funneled into that. I mean, I have a max position in Opendoor. I have almost a 40% position in my personal portfolio in Opendoor. But I've bought in the 8 range many times over the past few months.
Yeah. I remain a buyer, like I said. For me, it's a large position in my portfolio also. 40% though, that's okay. that's huge. That's conviction. Yeah, but I love it. I mean, I'm not far behind. It's about 30, just shy of 30% of my portfolio at the moment. So I have high conviction as well. So someone asked, okay, can't imagine. Well, I mean, Paul, to answer your question, people are buying and selling their homes already, you know, so the proof is in the numbers. If it wasn't the case, you wouldn't be seeing the exponential growth in that. So definitely take a look at the financial statements, Paul. You find your answer there, mate. Okay, so Just Invest Today says, where do you see Open in 5 years? That's a good question. Where do you see Open in 5 years?
Yeah, that's a great question. So Opendoor has a few levers that it's going to be able to pull over the next 5 years. So first thing, in 5 years, I think a significant minority of American consumers will be selling their home digitally. I think it'll be much more the norm. In fact, I think it'll probably be in the 20% range for the markets that Opendoor is active. So I think that's number one. Two, I think we're going to be seeing much more ancillary services being driven by consumers using the buyer dashboard. So Opendoor started with Sell with Opendoor. That's a wedge into the entire real estate transaction stack. And once you're in there, you can begin to aggregate homes, aggregate supply, and then therefore bring demand in. And that demand means people will be not only selling their homes to Opendoor, but also buying Opendoor homes. And if you're buying from Opendoor, it's really easy to package things like title and escrow, mortgage, home loans, home insurance, all these different little fintech ancillary services. Three, I would say that Opendoor becomes a marketplace. And so as opposed to being first party, there'll be a lot more third party transactions on Opendoor as it aggregates supply and demand. And so it'll be stealing eyeballs from current platforms like Zillow and Redfin to make that happen, because they'll have the most accurate home valuation model. I mean, they already do. The Zestimate is often off by, double-digit percentage points if a home hasn't been sold before. So if there isn't any recent selling data, Opendoor doesn't suffer from any of those missteps. It's accurate in all the markets that it's in, and the variance is very reasonable.
Yeah.
The last thing that I would add to this, and sort of the most exciting aspect, is this concept of Opendoor Home, which is Opendoor internalizing not just all these little fintech opportunities in the home transaction relationship, right? Because currently Opendoor is a one-off, infrequent transaction company, right? So they, a person buys and sells a home maybe once every 7 to 9 years. That's not a great business model overall, especially if you delight the customer. You got to wait that long to see them again. But I would say that as moving becomes easier, that time frame might compress a little bit, which is good overall for Opendoor's business. But the other thing I'd say is once they own all these homes, they're going to be able to offer and scale all these different home adjacent verticals, like hire a handyman, moving, home cleaning, pool maintenance, HVAC, right? Like all of these different home renovations and interior design, all these different things that they're going to be able to internalize and apply and provide to their customers as a consequence of owning so many American homes. It's an opportunity that no other company is going to have access to. And just as we saw Sell with Opendoor revolutionize residential real estate, I think that this is going to revolutionize how we own a home and how we maintain a home.
Yeah, agreed. I was in this chat with a Discord member. I was saying that when you strip it down to the bare basics, right, of what this business model is about, it's almost hard to believe that in 2022, it's still taking us so long to go through the traditional process of purchasing a home. When you think about like how Uber, Lyft, they revolutionized, pretty much ride sharing, or they introduced ride sharing, should I say. So like, how is it that the process buying a home can still go through so many pain points, so many people involved, so many people taking bits and commission and fees and this, that, in 2022. And it's hard for me to imagine that in the next, well, maybe not 5 years, but in the next 10 years, that this is still the main standard, that technology hasn't changed the way we buy and sell homes as a whole. It's hard for me to imagine that. But, and I believe in the next 5 years, from my point of view, I believe the iBuyers will have a lot more market share. I think we dropped to 1.7%. That's due to Zillow exiting. We were at 1.9%. That's the record. But I think within the next 5 years, especially in places like Phoenix, they seem to love iBuying over there. I think iBuying will take a huge amount of market share in the next 5 years. And again, it's a multi-trillion-dollar industry that's going to serve us well as being the market leader. And as long as we continue to maintain that leadership position, that's going to eventually trickle down to the bottom line. Because I think a lot of people are, I mean, it's good to be looking at a business bottom up, but if that's your sole rationale for investment, then you would miss out on a lot of opportunities. I mean, many businesses in the past, you would have missed out. So yeah, that's it down to the bare basics. So thanks for that, Tyler. I've got a question here from Peter. He's asking, like, what do you see as like the biggest risk? Okay, I know you're 40% in, you're pretty much almost all in this business. What is the biggest red flag, biggest risk that would make you lose sleep at night?
Yeah, I think we touched on a lot of what I would say are headwinds. It's not that I don't think that they're risks. They are risks. I just think the prevailing sentiment is that they're thesis killers, and I don't believe that. And I don't think the math or the facts support it either. I think it's important to be clear-eyed about your investments, especially as it goes down. There is a risk of confirmation bias. There is a risk of you sort of convincing yourself that you're right and that everyone else is wrong. And so you have to be really critical of an investment's operating performance. And indeed, when the Q4 numbers came out, and I was speaking with a few of my friends who are also closely analyzing the company, I was disappointed with some of the metrics. I didn't start with the headline metrics like, wow, revenue grew 14x. I talked about the parts that I was disappointed in and the parts that I think the company could do better at. But again, these are bumps along the road. And I think when you zoom out and when you zoom in, everything is there. All the data are there for a company that is revolutionizing the home transaction process. And not only that, but they're doing it despite all of these so-called headwinds and thesis killers. It really is a tremendous company, right? Like zoom out, for example, in 2021, Opendoor was supposed to do $3.5 billion in revenue. They were supposed to have negative adjusted EBITDA margins. They more than doubled revenue. They had positive adjusted EBITDA margins. They destroyed all estimates, both the ones that they themselves gave and the ones that I provided. Right? I mean, I think the company is truly firing. Perhaps not quite at all cylinders, but I think that's sort of expected for the growth that we're seeing. Like, what other company is growing as rapidly as Opendoor is? And it's really hard to figure out what are good comps. What can we compare this to? And with Zillow out, I think it confirmed a lot of people's fears about the iBuying model in general. But
yeah,
it's early days, and I'm really, really excited about the opportunity ahead.
Nice. Okay, so Mario pretty much concludes here. He says basically they're selling convenient services, which is so powerful. Again, yeah. And I think people also underestimate the power of convenience and time. I believe someone shared, I think it was Matthew on Twitter that shared something from Gary Vaynerchuk, and he realized, he said that Uber was one of his worst, or one of the investments that he missed out on. And he realizes that Uber is selling time, right? Uber is selling time, Uber is selling convenience. So in this instance with iBuying, they're selling time. Being able to buy, sell, tap a button takes a couple of days as opposed to a couple of months. That's premium, right? There's a lot of value to be put on that. So I think Opendoor is returning back time to home buyers and home sellers. And I think, again, it's a really misunderstood business, but that's very good. We love misunderstood businesses. Right. So another question from Mario is, would you say their cash on hand is healthy? And this reminds me of a question that I saw in my Discord as well. But I mean, Tyler, like, the weekend was incredible. We had so many questions in my Discord. And this was a great question. Someone asked how they plan to scale. How can they scale with the current amount of cash they have in their hand? It doesn't sound like they have enough cash to facilitate growth that they want or they expect in 2022. And as a result, Mario asking, would that lead to more dilution in the future? And I know We have a line of credit that values up to about 11 billion. But yeah, did you want to touch on that, Tyler?
Yeah, that's a good question. So they've 2.2 billion cash on hand, and then access to about 9 billion in debt.
Yeah.
So at minimum, with 120-day holding periods, they're capitalized for 33 billion in revenue. Yeah, so I think they're definitely capitalized enough for 2022 growth, and they said as much in their shareholder letter. So I don't expect any dilution in the near term, and certainly not at today's stock prices. Yeah. So I think they're definitely well capitalized.
Yeah. Okay. Paul says thanks for greetings from Germany. We appreciate you, Paul. Thank you for asking your question. Right, so we've got 5 minutes left. I know you said you've got an hour, Tyler, so I really appreciate you giving up your time for us today. I also want to quickly touch on the recent news that came out regarding their partnership with the NBA team, Suns. I think this was one of the most beautiful pictures I've seen in a while. Seeing Opendoor in the background in the stadium, again, what I was telling my Discord members, Phoenix is one of the, I think they have, 11% of the iBuyer market share. So in Phoenix, seeing Opendoor everywhere, I think that was just glorious to see. I'm going to scroll down again. You can see again, sell your home. Like that's going to intrigue interest. Like I thought that was amazing. I'm just gas. You can see Opendoor again on the rim right there. Opendoor. Yeah, like so. What when you saw that news? What was your initial reaction when you saw that news?
Yeah, I think we talked about this. We talked about this a little bit. Me and a few friends, sort of what Opendoor's customer acquisition strategy was. I think this is super cool. Partnerships, brand recognition, especially unaided brand recognition, which is what you see driven by these sort of billboards in the background, as opposed to commercials. I think like I said, I think this is super cool. At the end of the day, their biggest customer acquisition engine is going to be a fantastic customer experience, because these people become evangelists, right? These customers, they tell all their friends. As part of my commitment to sort of being clear-eyed about the investment, I read at least 20 Opendoor customer reviews per day if I can, because I want to know exactly what the customer experience is. And I think when you look at that, I mean, it's crazy how happy people are with the opportunity to sell their home or buy their home on a digital platform that is convenient and simple and secure. And the people, in the reviews are like, I've told all my friends. I have 2 friends that are now buying or selling their home on Opendoor. It's really impressive that, they don't necessarily need to have this viral growth marketing strategy like you'd see, for a Cash App or maybe even SoFi. They're really just obsessing over the customer, and then the customer's doing the rest.
100%. We're seeing the network effect in the numbers. I mean, ultimately, they say the saying is, people lie, family lie, friends lie, but the numbers don't lie. So we're seeing the network effects, and I love the words that you used there, that the customers become evangelists for the company. I mean, who wouldn't? If you've had a great experience in anything, and someone close to you that you care about is about to embark on something similar, you can recommend this experience that you've had, and you can vouch for the company, vouch for the service, and especially something in as difficult and rigorous as real estate purchasing. So someone there, Bob says he's 16 and has 2,000 shares. Oh wow, killing it, Bob, killing it at that age. That's insane. Mario says we need to grow this community. We are, and it will continue to grow, but it has to be organic. I believe it has to be organic, and that's why Tyler's on. I think it's me and one other person on YouTube that's talking about Opendoor. So we're gonna continue talking about Opendoor. I think it's Mike. Yeah. And I think that would be it. Okay, guys. So we've got 20 seconds left. I just wanted to share my appreciation for Tyler. Thank you so much once again, brother. I know you're crushing it with SOFI, so congratulations on a great quarter of SOFI as well. But Opendoor, it is the monster. This is the beast. And I appreciate you sharing your thoughts and being open to hearing the other argument. You know, I didn't want to come on here and be like a bull and just, yeah, it's Opendoor, amazing, amazing. You know, thank you for taking the questions. And I hope this has given people some confidence as well. Again, guys, let me pull up the charts, the stock chart. It looks ugly. Let's just call it what it is. But, you know, if you believe in this company long term, the next 5-10 years, you know, these are incredible opportunities. Remember, it's not financial advice. I'm not giving any financial advice. Tyler's not giving any financial advice. But focus on the business, okay? Tunnel vision, focus on the business, focus on the management execution. The stock will do whatever the stock will do. You know, we can't control stock price, but we can control what we buy. And I think if your conviction is there, then these are great opportunities in the long term. Again, think 5-10 years down the line. Do you really see real estate being as it is? I think there's change. Change has already come, and change will begin to continue to spread outwards. And I think Opendoor are the leaders of that. All right. So yeah. So again, thanks so much, Tyler. Your article, guys, check out his article. Please, please, please check out his article. It will be in the link in this. It will be in the description below. Any last words, Tyler?
As always, great chatting with you. Thanks for having me on the show. I really appreciated that we kind of took a little bit of a more sober approach to evaluating Opendoor and the headwinds and potential issues ahead. I think regardless of how excited or bullish we can be on this company, like I said, it's super early days, and you know, the stock price has not reflected the opportunity that we necessarily believe. For me, I do, like you said, I think this is an incredible opportunity, and I've been able to maintain my conviction and layer into my position because I've been able to build conviction as a consequence of researching this company so deeply. And like I said, always be clear-eyed about your investments, because it's easy to get confirmation bias on these things. But Opendoor, in my opinion, is, I mean, it's a once in a generation opportunity.
Agreed. And we'll leave it there, Tyler. I appreciate you. You see everyone in the chats are saying thank you. We love you on this channel, man. So yeah, I guess maybe next earnings. We'll see. But yeah, I appreciate you, brother. Thank you so much. Thank you everyone for tuning in. I know it was a bit spontaneous, but yeah, we did it, and yeah, conviction is strong as ever. So thank you guys, and we'll see you next time. Cheers. Bye.